Hey everyone, welcome back to This Week in Markets. To discuss commodities, we're talking with Tiho Brkan. He's the author of The Short Side of Long blog, and he's also a fund manager based in Hong Kong and Australia. Tiho, buddy, how are you doing today?
I'm excellent, Jordan. I haven't heard from you in a while. How are you?
Well, I'm doing pretty well. Thanks for asking. Talking about commodities, Tiho, you've been talking about sentiment in the last several weeks on your blog and also your free newsletters. Can you just take us through what's going on with sentiment in commodities right now, and maybe commodities as a whole, and maybe some specific individual commodities that catch your eye?
Definitely, Jordan. It's very interesting how people feel today about stocks, the way they felt about stocks, say, 4 years ago. In the same context, it's also very interesting how investors and market participants feel about commodities today as they did 2 years ago. As your readers most likely know, commodities peaked in May 2011. Most commodities actually peaked a little bit earlier because majority of the CRB is connected to the agricultural component. So a lot of commodities there, especially the softs, peaked in earlier in February and early parts of 2011. So when we look at commodity sentiment right now, we have to look at it in the context that we've been declining for over 2 years now. So essentially, the positioning on the commitment of traders has gotten down to the lows that are usually close to resembling the March 2009. The way that I do my weighted CRB commitment traders report is I mainly use the contracts that really work on both the upside and the downside, and these include copper and gold and silver, and they include heating oil and quite a few other industrial metals, as well as agriculture like sugar and wheat and corn and coffee. And when I look at that type of report, I think the commitment of traders is down to the March 2009, December 2008 low. So incredible amount of washout in the commodities, and definitely the inflation trade is not the consensus right now. Also confirming this is the Merrill Lynch Fund Manager Survey, which is a great survey that Bank of America Merrill Lynch releases every month, surveying, I think, over 300 hedge fund managers and almost up to $1 trillion in assets. So it's a very good way to look at what real life fund managers are thinking about and the way they're positioning themselves. And there we have underexposure towards commodities at the lowest level since December 2008, which is, I think, 30% underexposure. And if you go to my blog, Short Side of Long blog, you can see that chart that I posted there a week or two ago, which is, it just looks like a real panic there, essentially. So commodity sentiment in general is very different to the way that it was 2 years ago when the inflation trade was in its full glory.
Tia, let me just do a quick follow-up on that because with this week's interviews, my earlier interviews, we didn't have a chance to discuss the updated COTs, which come out on Fridays. We're speaking here on Friday.
Yes.
Could you just mention, I don't know, but could you, if you saw the new COTs in gold and silver, it looked like there was a lot more speculative liquidation there. Any comments on those two commodities in
Definitely.
particular?
Definitely. I mean, I commented in my last newsletter already that the small speculators in gold a couple of weeks ago reached a lower level than they did in October 2008 bottom, when gold bottomed around $700 per ounce. They actually went net short gold for the first time ever in history. And then the non-commercial speculators, as I call them, hedge funds, the larger investors and market participants, they liquidated a huge amount this week. And I think we were up to 80,000 contracts last week, but now we've dropped down to 57,000 to round it off. So a huge liquidation, despite the fact that gold did not make a new low. And then also, if we look at silver, quite a similar picture. We also had a drop, not as dramatic as in gold, but silver also. I think this is one of the lowest positions since 2001. I think probably even lower, to be honest with you. We only have 4,500 contracts net long silver. And if we were to compare that to the recent intermediate peaks, for example, when silver was trading at $37 an ounce around February 2012, when the ECB announced LTRO2, we had about 30,000 net longs, as opposed to 4,500 now. And recently, when QE3 was announced, it's ironic how every time they announce a program, gold and silver investors get slaughtered. But we can discuss that another day. But when QE3 was announced, we had 40,000 net longs on silver, so everybody was expecting the inflation trade to continue, and now we have only 1/10 of that, which I already mentioned, 4,500. So, as a contrarian investor, it definitely makes sense to purchase silver now or to purchase gold now, as opposed to where it was in September 2012 when everybody was bullish on it. So, from that aspect, I think in precious metals side, and also I see liquidations have been happening also in copper. A month or so ago as well. So the whole metal aspect space, including the precious metals, have been dramatically liquidated.
Okay, now Tiho, getting back to the commodity sector at large, I mean, we've talked about this before in the last couple of years, how the stock market, the U.S. equity market, has had a tremendous advance to new all-time highs. The U.S. government bonds have also performed very well, although they've been a little weak of late. Well, at the same time, commodities have been in a cyclical bear market. So does this mean that the next time we see a cyclical bull in commodities, that U.S. equities could probably be in a cyclical bear? What's your take on that?
Well, correlations are, I mean, first of all, I would like to say that your correlation point of view is very interesting, and it's definitely a valid point. But correlations are very difficult to forecast because markets fall in and out of correlations all the time. And I think since the March 2009 low in majority of the risk assets, there was this risk on, risk off theme that was formed within the markets. And I was always against that type of a thing. I was in my blog, I was always against that theme because I've been studying markets for a long period of time, and historically assets have correlated together, then they correlated inversely, and they've gone on and off, and they do whatever they want based on, I think, fundamentals and the current conditions in the market. So a market participant, first and foremost, should try to read every asset on its own. That's my advice. To try to answer the question, I'm not sure what will happen with the U.S. equities if commodities start to rally, or whether they'll both fall. So if commodities are just forecasting a slowing economy outside of the U.S. and eventually the U.S. economy will start slowing as well, and then they'll all go down in tandem. I'm not 100% sure on that opinion, but I will say this one observation. If I look at U.S. equities on their own, in my opinion, they're extremely oversold or overbought now. They were extremely oversold in March 2009, and as a very good investor, Jeffrey Gundlach, a famous hedge fund manager, just recently said, this is one of the most bullish times since March 2009 low, which was the most bearish time. So we have a complete opposite spectrum and trade and the feeling of market participants here. And for commodities, it's very interesting, including precious metals and especially agriculture too, the way that investors felt 2 years ago about commodities and the inflation trade, and the way that the BHP and Rio Tinto, the world's largest miners here in Australia, were expanding their capital expenditure programs to new heights, and exploration was booming because we also have an exploration company, so and participate in some of that work. So we definitely know what we're talking about. We're in a complete different tangent swing now, where we are experiencing capitulation throughout the whole sector, I think. So from that aspect, I think commodities could rally on their own, or they could decline a little bit more. We could have a further washout before the inflation trade starts. But which way I would invest, the best answer to that is to look at every asset class on its own. For me, I always like to purchase a relatively depressed assets because they have more of a chance from a contrarian point of view of rising rather than chasing the momentum. So right now, I definitely wouldn't be buying stocks, and instead I'll be looking to gain exposure in some of the extremely liquidated markets like silver that are down 60% from the all-time high more than 2 years ago, and with investors, as we already discussed in the commitment on traders reports, at depressingly low levels of exposure.
Okay, now before we get back to silver, and I also want to ask about the agriculture commodities. Tiho, on the sentiment front, I know you have an exploration company there, and we were talking I think a month or so ago, and you were just telling me a story about what you saw going on the ground there with BHP Billiton, and just exploration budgets being out of control. And I think given your firsthand experience there, maybe you could just talk about what the conditions were like at that time in 2011 and then what they're like now. I think our listeners would appreciate that.
Sure. I mean, I didn't spend as much time on the ground as some of my business partners have because I do more financial type of stuff. But having said that, when I was there on the site, I mean, the exploration was booming to the point where we used to have drilling sites have 7 to 8 geologists, and 6 of them would have their shirts off, and they'd be sitting in a car with grass between their teeth and drinking Coca-Cola, while the other 2 would be working. So, and the wages were astronomically high. At the same time, it was an oversupply of motor vehicles, oversupply of all type of equipment, oversupply of labor force, as I just already mentioned, not just geologists, but field technicians and all types of expertise. It was just I'm not saying that could essentially be in a commodities boom peak, euphoric peak, because this wasn't very much the case for the whole of the globe, but in certain pockets of Australia, that was a very euphoric boom. And at that point in time, I used to look into my business partner's eyes, and we used to think without even saying anything. And I just used to think, man, like this cannot continue forever. This is too good to be true in a sense. And that was essentially May 2011, interestingly. So I think it was only few days before that the CRB index peaked, and I guess none of us have a crystal ball, so we didn't know at the time that was the ultimate peak, and commodities would decline from 700 on the continuous commodity index down to say 500 in last year at the low, or 530 currently. So we didn't know whether commodities were going to go down for 2 years, but we were gearing up for a China slowdown, and we made sure we removed the leverage from the balance sheet, so we didn't over leverage ourselves with the vehicles. One of our competitive companies had 60 employees, including geologists, field technicians, and so on and so forth, and they had 40 vehicles. So there was almost as many vehicles used. Like pretty much every single person had a car. They were just driving around. It just looked like total madness. Nobody was doing any work on the site. It was just extreme case of over expectations to where this whole boom was going to go. And I think eventually that competitive company ended up selling most of those mine spec cars, which are much more expensive than just buying a normal four-wheel drive to use on a mine site, because when you have to mine spec it, you have to invest even more money into it. I think they ended up selling it on eBay and through other various accounts after the company sort of experienced a huge downturn, and they sold company cars for a quarter of the price. So it just shows you the difference between today and the sentiment and the mood today on the ground and also in the markets relative to the inflation trade in its full glory around April, May 2011. Finally, one more observation I'd like to make. In the Merrill Lynch Fund Managers Survey, the 300 or so fund managers, the expectations for inflation and short-term interest rates to rise are one of the lowest ever. So that doesn't necessarily mean that these fund managers are wrong, but majority of the time when everybody's thinking the same thing, the chances are nobody's doing any thinking, and this is usually when some type of a trend change could occur. I mean, agriculture, industrial metals, base metals, precious metals, majority of these commodities have been declining for 2 years, and maybe we have a little bit more left in store, but I think we're much closer to the bottom today than we were, say, a year or so ago.
Okay, Tiho, let's talk about maybe over the next. I mean, I know you're a very long-term investor, but in particular, maybe over the next 2 or 3 years, which single commodities are your favorites, and can you tell us why?
Sure. I mean, I'll tell you why first, and I'll tell you maybe which ones are my favorites after. Not that I'm pretty sure my picks are not going to be 100% correct anyway, because markets are very difficult to gauge. I mean, anyone who thinks they know how things are going to play out is probably not telling you the truth. So having said that, the reason I like agriculture, and the reason to answer the why, is because I think agriculture is the most depressed out of all commodities. If we just observe the price over this secular bull market, I think oil, like Brent crude and Western Intermediate Texas crude, they have risen from levels which was almost close to $10 a barrel in early 1999 to over almost $150 a barrel in the peak in 2008. And maybe we will visit that peak, maybe we won't. I'm not 100% sure, and I don't want to make any forecasts, but I think commodities are still in the bull market. But my point here is, even at $100 a barrel, that's a 10 times return on energy instruments like Brent crude or heating oil, or even Western Texas Intermediate, which is trading around $92 currently, which is 9.2 times. And then if we look at returns on gold miners or some of the other producers like steel makers, which had a tremendous run up to 2008 highs, they've also experienced great returns. Rio Tinto, BHP, they've went from single-digit dollars on the stock prices all the way up to $40, $50 in Rio Tinto's case, $150 on Australian share market before the bubble popped. And then if we look at, for example, copper, that's also gone up tremendously, and so has silver. Has done okay. We'll get back to silver later, but silver has also up to $50. It was up 10 times, I think, at one point, similar to crude oil, even though silver and crude oil are two different things, because silver is a very small and volatile market and can be moved much more in either direction. The reason I like agriculture, therefore, is because the advancement has been very small. And if we use real prices, which means inflation-adjusted prices, the pressed level and the base that they're currently at is extremely low. I mean, commodities like sugar, commodities like cocoa, and commodities like coffee, in inflation-adjusted terms, these softs, they're incredibly cheap. And obviously, I also think even though soybeans and corn have made new highs during last year's American drought scare, they're a little bit pricey right now, and they have been correcting since September, October of last year, just like the rest of the commodities. But having said that, on inflation-adjusted terms, they're still very low. So in general, I think all agricultural products are probably the best investment one can make going forward.
Okay, Tiho. Well, on that note, before we close, why don't you tell our listeners where they can find your work and how they can sign up for your free newsletter?
Sure. We're looking at the short side of long, blogspot.com. Hopefully, eventually, there'll be shortsideoflong.com if I ever get around to redesigning the website and creating my own domain. And if you go to the blog, or you can just type in short side of long on Google, and it'll take you there. And you can sign up for the free newsletter, which I publish fortnightly or bi-monthly, whichever way you want to look at it. And and I try to put a few posts a week on there, including a lot of sentiment and contrarian aspect. That's how the blog started, and that's probably the way it's going to remain. So I do quite a lot of weekend summaries. You can see how all positioning happens throughout the market. And in newsletters, I discuss more fundamental aspect and the longer-term investment, which is for more people that are more interested in investing and sort of managing capital as opposed to just doing trades.
All right, Tiho, buddy. Well, on that note, thanks so much for joining me today, and I wish you all the best, and look forward to speaking with you again soon.
Absolute pleasure. Thank you for having me on.